Okay, so good evening students. In previous lecture, we illustrated several transactions of a firm that occurred. We prepared a complete set of financial statements immediately following our discussion of these transactions. For practical purposes, businesses do not prepare new financial statements after every transactions. Rather, they accumulate the effects of individual transactions in their accounting records. Then, at regular intervals, the data in these records are used to prepare the financial statements, income tax returns, and other types of reports. The sequence of accounting procedures used to record, classify, and summarize accounting information in financial reports at regular intervals is often termed as accounting cycle. The accounting cycle begins with the initial recording of business transactions and concludes with the preparation of a complete set of formal financial statements. The term cycle indicates that these procedures must be repeated continuously to enable the business to prepare new, up-to-date financial statements at reasonable intervals. The accounting cycle generally consists of 8 specific steps. In this lecture, we illustrate how business journalize or record transactions, post each journal entry to the appropriate ledger accounts, and prepare a trial balance. The remaining steps of the cycle will be addressed in upcoming lectures, that is making end of period adjustment, preparing an adjusted trial balance, preparing financial statements, journalizing and posting closing entries, and finally preparing an after closing trial balance. So here, let's start the role of accounting records. So you can see that I have mentioned over here the role of accounting records. That number one is, like, first let me discuss you the cyclical process of collecting financial information and maintaining accounting records does far more than facilitate the preparation of the financial statement. Managers and employees of a business frequently use the information stored in accounting records for such purposes as establishing accountability for assets and transactions under an individual's control. Number two, keep tracks of routine business activities. So keeping track of routine business activities such as the amount of money in company, bank accounts, amount due from credit customers or amount owed to suppliers. And number three, obtaining detailed information about a particular transaction. Number four, evaluating the efficiency and performance of various departments within the organization. And lastly, maintaining documentary evidences of the company's business activities. For example, tax laws require companies to maintain accounting records supporting the amount reported in the tax return. So now, the ledger. The ledger, that is very commonly known as the T accounts. So an accounting system includes a separate record for each item that appears in the financial statement. For example, a separate record is kept for the asset cash, showing all increases and decreases in cash resulting from the many transactions in which cash is received or paid. A similar record is kept for every other asset, for every liability, for owner's equity, and for every revenue and expense account appearing in the income statement. The record used to keep track of increases or decreases in financial statement items is termed as ledger account, or simply an account. The entire group of account is kept together in an accounting records called a ledger. So here you can see that accounts are individual records showing increases and decreases, and the entire group of account is kept together in an accounting records called a ledger. Here, for the sake of simplicity, I have taken the three titles of the account. One is the cash, other is the account payable, and third one is the capital stock. And the reason of taking these titles is that cash, the nature of cash is asset, the nature of account payable is a liability, and the nature of capital stock is equity. So you can understand it very clearly that in the double entry records, we have all those assets, liabilities, and owner's equity. So for the sake of simplicity, like whatever the journal entries you are just posting in the double entry accounting, the equality of debits and credits. So if you are going to post any entry, so in our previous lecture we had discussed the rules for debits and credits that are designed so that every transaction is recorded by equal dollar amount of the debit and credit. And the reason for this equality lies in the relationship of the debit and credit rules to the accounting equation. And we discussed that assets minus liabilities is equals to owner's equity, or debit balances are equals to credit balances. Now the use of accounts, that increases are recorded on one side of the T account and decreases are recorded on the other side. And here I have clearly mentioned that we cannot specifically say that increases will be recorded on the left hand side and decreases will be recorded on the right hand side. No, it totally depends upon the title of account. Like if there are assets, so any increase in the asset will post it on the debit side, that is on left hand side, or any decrease in the asset, it will post on the credit side, or you can say the right hand side. Similarly, if there are any liabilities, so if the liabilities are going to increase, it will post on the credit side, whereas the liability decreases, so it will post on the debit side. And similarly, the owner's equity, when it increases, it will post on the credit side, and if it decreases, it will post on the debit side. So whatever the rules of debit and credit, which we had discussed in our previous lecture, this will be applied here as well. The only difference between journalizing the entry and then posting them, or copying and posting them in the ledger account, is that we are picking out, or we are taking out all those accounts which are related to cash, or which are related to specific assets or specific liabilities or specific owner's equity. This should be classified and summarized in a particular accounts. So here we can see, let's see how debits and credits are recorded in the cash accounts for JJ Lawn Care Services. The same example we are resuming what we had discussed earlier in the previous lecture. Okay, so now let me refresh your memories that cash, the nature of cash account is an asset, which we discussed earlier, and all those entries which are increasing the cash, or that would be posted on the debit side. That means we have received the cash when the business has been started, and then we received $75 when we have sold out certain tools and we have received some amount of money from our customers. And third one, that we have rendered the services to our client and we have received the revenue from our clients. So this is the total amount of money that if we are going to sum them, it will be equals to around 8,825, I guess. Similarly, on the credit side, we have mentioned that where the cash is going out from the business, or the nature of cash is asset. So when the asset is going to decrease, it will be posted on the credit side. So you can see that the cash has gone out and we have purchased tools and equipment that is worth 2,500, and actually we paid the cash. Similarly, we have paid 2,000 for the truck we have bought. We have paid 150 to our suppliers from whom we have purchased the tools and equipment, and finally we have paid for the fuel and gasoline which we have consumed or used for the earth mover and to run the truck. So that is why these are the side of the payments that are mentioned on the credit side, and these are the receipts of cash that are mentioned on the debit side. So if we are going to close this account, it is very simple. Like say for example, this is if we are going to sum them, it will become 8,000, 825. On the other hand, if we are going to add this side, that is 2500, 2000, 150 and 50, so this I would guess it's 4700. And if you see the balance, like you have thoroughly received 8825 and the total amount you have paid is 4700, so the difference is your closing balance, and that is 4125. So the balance is the difference between the debit and credit entries in the account. The situation is very simple, that if you are going to close this account, so this is basically, you can sum them and you will get that this is basically 8825. And on the other hand, you will copy paste this amount again, that is 8825, right? And now if you are going to sum this figure, this is exactly 8825. But if you are going to sum this figure, this is not equivalent to 8825 because there is a deficiency of 4125. So 4125 will be the balance carried down. And on the opposite side, you will bring the balance brought down, that is 4125. So in this way, you can carry down and brought down, or you could say the set of the balance or balancing of the ledger account according to the nature of its account. Usually we have noticed that the balance brought down of assets will be on debit side, the balance brought down of the liabilities will be on credit side, and the balance brought down of the owner's equity will be on credit side. Balance brought down of the expenses will be brought down on the debit side, whereas the balance brought down of the revenues will be on credit side. But there could be usually like let's suppose the balance brought down of bank is on credit side, that means it is no more of an asset and it is one of the liability in case of the overdrawn facility. If the bank is going to facilitate an OD facility, so in that situation it could be a liability. In that situation the bank balance could go to negative. So now as we discussed earlier, the rules of debit and credit, I'm not repeating that thing again, but just to remind you that the debits and credit effects account as follows. Like we have a general equation, that is assets are equals to liabilities and owner's equity. When assets are going to increase, it will be posted on the debit side. When assets are going to decrease, it will be posted on the credit side. Similarly, when the liabilities are going to increase, it will be posted on the credit side. When the owner's equity are going to decrease, it will be posted on the credit side. And when the liabilities and equities are going to decrease, it will be posted on the debit side. So that part we had discussed in detail in our previous lecture. So now you know that in the double entry accounting, the equality of debits and credit, that also we had discussed in the previous class, like the sum of the debit balances must be equal to the sum of credit balances. And as we discussed that if you are going to post the ledger account,
Thanks for watching. For new video updates press subscribe button so you will notified.